Hi, this is Stuart Funky from Corporate Coaching Financial. By now you've probably heard a lot from me, and today what we're going to do is we're going to learn about a specific principle that corporations have always used for years and years. It's nothing fancy. It is mathematical, so it may be a little confusing at first. We do not expect you to understand this coming into the game here. We're going to go through the basic, what we call income snowball principle. It is one of a multiple number of tools. I want to compare it to how a corporation used money compared to how we individually have been using money. So let's go get right into it, and we'll start talking about the income snowball. As you know, we get paid from somebody. We get an income. We get paychecks. We get pensions from somebody, and from that, that money that comes into our system goes into a checking account. From the checking account, we go down below what we call below the line and pay bills. They might be, we might have done a good job of breaking it up into categories. We've probably talked before about 5 wealth secrets of, one for giving, one for savings, one for investing, one for spending, and don't let those buckets meet. And of course, in our spending, we're paying off debts such as our car payment or our college payment or our house payment. And if we have a bunch of left over, we have that money floating into our savings account. Now, anytime something happens, need a car repair, medical bill unexpected, then from our savings account, we have the money to come back into the checking account to end up paying that bill off. Now, if you're a good steward of your money and you're doing what everybody tells you to do, you might want to have as much as 5 months or 6 months worth of emergency money in a savings account. So let's just take 5 months and let's just use a small number of $5,000 per month is what your overhead cost is. So that means I probably have, close to $25,000 if I'm doing everything right in my emergency fund sitting in my bank. Now, what's the bank doing with that money? You basically have loaned the money to the bank, and they're paying you how much for that savings and checking account? What did you say? I think I heard you over the internet say less than 1%, maybe 0% or 0.5%. What does a bank then do with your money? Well, they don't sit it in your savings account and stick it in the vault back there. They actually go and loan that out, correct? So a bank will basically, which is another larger company, corporations, we want to learn how they do it so we can kind of mirror that. The bank will loan your money out anywhere between 4% to a really good home mortgage, maybe up to maybe 28% to those credit cards that people are late on. But you know what? They actually do that up to 9 times. So you do the math, say 10%, 9 times, without even calling volumizations or loan fees, that's close to 100% return on money that you have loaned them for less than a 1% return. Wow. How come we don't do that? Well, the reason is we didn't know how. We had nobody teach us. Okay, coming back here to our cash flow system. We'll come back to the bank a little bit later, but come to our cash flow system. This is how we do our flow. And if we have really good savings and excess money, maybe an extra $500 a month or something like that, we might be then putting that into our 401k or IRA. And what's the goal of this 401k and IRA? Well, we've been taught over all these years that we're going to build this IRA up so that we have a big retirement account so that when we retire, we have $1 million out there. How close are you guys to getting $1 million? By the way, how much will $1 million actually give to me in my retirement if I was relying on that for cash flow? Well, obviously we can't make 10% all the time, and if we use the full 10, we wouldn't, it would deplete a lot and go away. So the number that the financial advisors use is usually something called like about 4 to 5% of what we call spend down. So if we use the math of 5% against $1 million, that would give you a cash flow of $50,000 per year that you could live off of. Okay? Now, I want to talk about how corporations think differently. They think about cash flow. They think about building flow of income so that they want this $50,000 too, but they don't want to invest $1 million to get 5% return to get that going. Plus, we're also subject to the market volatility in this process too. So I don't know how you guys all did in 2008 when the mortgage industry fell apart, the stock market fell apart, and a lot of portfolios cut in half. So $1 million, all of a sudden I'm looking at $500,000 in losses. Ouch, that hurts. Okay, well, let's talk more about a corporation now. On a corporation, let me just read you from our executive summary of how corporate coaching financial is a little different than just getting out of debt or using a cash flow system where you put money in envelopes. And that's all good. I don't mind any of that. We just want to take it to the next level and give you tools that the business world has been using for years and years and years and years. This is not fancy strategy. This is something corporations do. Let me read to you what one of our senior partners, Charlie Albert, who has worked in the corporate world, setting up quality control, actually writes in our executive summary introduction. We have noticed that personal finance are managed differently from the finances of most advanced corporations. Corporations optimize their cash flow by creating vision and setting goals and measuring and establish accountability in areas of inventory and expense management, cycle time reduction, productivity, accounts payable, accounts receivable, return on investment for capital projects and budgeting, and cost expense overhead control, and others. The tools corporations use are lines of credits and sweep accounts and strategic investments and other debt instruments. They look at tax optimization, formal cost and quality improvement programs, supplier financing, and debt service optimization. Whew, I get tired reading all this stuff. Cash flow monitoring and projection and others. Corporations have CFOs and accountants and engineers and managers on staff working with consultants and bankers and a network of experts to make these things happen. In other words, they have vision, strategy, and they are well coached. Individuals and small businesses typically default to ineffective and efficient use of cash. So our job is to help you get some of these corporate thinking, corporate tools into your small business or your personal life so that you can apply those same principles. Let me take an example of Costco real quickly. Oh, I love Costco. I have a rule that says if Costco doesn't have it, you don't need it. Anyway, I don't know if you knew this, but the average Costco holds about $3.5 million of inventory per store. Now, how much do you think they've actually paid for that inventory that you come in and slide your debit card or charge card through to buy that inventory? It's zero. They haven't paid for it. Because of the management of their cash flow, either you and your debit card or charge card have actually paid for that inventory before they've even paid the vendor for it, which might be a 30 or 60-day hold. So basically, they're cash flowing about $7 million of not their money, but the vendor's money's in your money. Now, what if you could do that? What if you had that ability? Okay, let's come back to the sheet again, and let's take a look at how corporations do that, almost like we do in our personal accounts. Okay? Again, reviewing, your money comes in here, it goes to your checking, you pay your bills, you put the excess in your savings. If you have excess from that, you try to build up a long-term portfolio so that you can retire. Okay? And we want to get all these debts paid off in the process. Now, there's another seminar completely about debt elimination. That's a part of it. Right now, we're talking about creating cash flow. So, the corporations do this almost exactly the same, except they use operating lines of credits from the bank. And this truck that represents my sweep account here is just going to go back and forth and begin to take that cash flow and begin to end up buying a variety of different products, depending upon what the economy is at the time, that will actually generate cash flow. Maybe another store, maybe whatever. But in this case, we're going to get simple, say, how do we act like the bank? How do we act like corporations? And the only difference is here, instead of this money going from the checking into the savings for the excess and getting me paid, basically nothing for that $25K there and allowing the bank to use it, we're just going to send it over to this sweep account. Now this is basically kind of a checking account, operating line of credit that works like it, just like the savings except in reverse. And when I need money, I can simply pull it back over here when I need to fix my car, put a roof on my house, etc. But what I'll do is I'll use this operating line of credit to, say, borrow $10,000 from the bank. Now, I could secure that with my own $10,000. Some people want to do it that way. Some people just as soon use just the bank's money only. That's another discussion based upon the individual. We can talk about that later. But we're going to take this company, this $10K, just like Costco does, or McDonald's or whatever, and we're going to get some sort of investment. And I'm going to say that this investment is going to generate us, somewhere around a 10% return. It could be a little higher, it could be a little lower, depends upon the investment. We want to make sure risk is covered. We'll cover that in separate discussions, what makes sense for you later. But the difference is I'm going to have this 10K pay me back into my sweep account, principal and interest payments, and if you compute that out, that comes out to around $330 per month. Now the cost for borrowing this 10K might cost about $50 per month. Okay, so I'm getting $330 in and I'm paying out $50. So guess what? My cash flow is ahead by $280, right? Now, let's go back to how this money is flowing into this cash account that normally was going this way, but then flowing over to here to build this. I'm going to say, because of some of the other things that we're going to teach you on how to control expenses, measure what you want to spend money on, making sure that IRS is not, keeping your money for you till the end of the year and they're paying you 0%. Track what you really want to do. Again, this is not about eating beans and rice and beans for 7 years. This is about staying in the same cash flow that you're currently doing the same things. And let's just say you have an excess earnings that you earn as well, from whether it be from pension or paychecks. And for the math in this particular illustration, I'm going to assume that this is coming in at about $1,000 that is also flowing in general through this account. Okay, so with that $1,000 coming into this account, $1,000 into $10,000, if that's all it was, would take about 10 months to pay off this $10,000, correct? And this again, of course, is $330 coming, so it's really $1,330 coming in. And based upon the float and some of the other things, this will actually get paid off in about 6 months. Okay? Do not expect that you're going to totally understand this first time around. It takes a while to get this. We are there to guide you through these math equations, but this is all math. Now, when that's completely paid off, obviously I'm not paying $50 a month anymore, but I'm still getting $330 a month. But I can go ahead and crank up my line of credit again, my operating account, and get another $10,000 new, other one's paid off, and get another $10K of this. When I do that, wow, I've now got a second $330 a month coming in. So that makes $660 plus my $1,000, so now I got $1,660 going in to pay off that new $10,000. Consequently, since I have more money coming in faster, it only takes 5 months to pay that off this time. When I say, well, let's use my line of credit again, it's already paid off, I can just borrow the same $10K again. I've already paid off the first two, and I've got $20,000 of investments out here paying me $330 per month. I get a third one. Now it takes 4 months. I get a fourth one, a fifth one, a sixth one. I can continue this process. And let me just go on to tell you that this process, assuming that this is all you were doing, which is allowing this process with the extra $1,000 that you got from controlling your spending and making sure you weren't giving IRS money or from your excess cash flow, would give you approximately 10 of these over a 36-month period of time. Now, in the 37th month, remember I told you that this was getting paid back to you on principal and interest over 36 months. So in 37 months, this particular investment, whatever it was, is gone. But I've still got $90,000 more that's paying me $330 a month. And if you add that up, that's in excess of $3,000 per month. So if I take my $1,000 that was flowing already through the system plus my $3,000, I think if I add those together, that would equal $4,000, right? Now, if I take $4,000 and divide that into the 10 that I used to buy that last one, how many months is that for the $4,000 to eliminate $10,000? Well, you guys are great on your math out there. I heard somebody out there in internet law tell me 2.5 months. So instead of the 6 months, it's now 2.5 months. The snowballs are getting bigger and bigger and bigger. When that happens, we can now say, well, let's take some of this and maybe we want to do something different. Maybe we want to get a business. Maybe we want to buy some cash flow real estate. Maybe there's other things that we're going to do. Maybe we're going to show you next time, we're going to show you how to eliminate all your debts. By the way, if I eliminate debts, what happens to my cash flow? If I'm no longer paying $1,000 for a mortgage, I guess that increases my cash flow by $1,000, doesn't it? College loan, college debt. Do not expect to understand this totally. The long-term goal of what we're trying to accomplish here is to get things started so that you can act like the big boys. Correct measurements, correct matrices, correct visions, correct use of cash flow, so you're not letting the bank use your money instead of you, and you're spending on what you want to do, eliminating debt, and creating permanent cash flow, whatever that might be. So that's our first lesson on creating snowballs. Feel free to watch this 3 or 4 times because it'll probably take that much to figure this out. And again, we're here to hold your hand. It's kind of like somebody that wanted to learn to swim that never knew how to swim before. You don't just throw them into deep end. You've got to walk with them. You've got to say, here, let's learn how to dog paddle or treadmill first, and then the crawl stroke. And then finally they might get into butterfly down the road. They might even want to become an Olympic champion. But all along the way, you're getting education and you're getting coaching, and we have some accountability to help you reach what you want to accomplish in your life instead of having all your financial advisors telling you what they want to accomplish in their life. This is your money. We want to help you learn to manage it in a godly way. Thank you. Stuart Funke from Corporate Coaching Financial.